There's a huge speculative group trading treasury bonds right now. It's not like the old days of 2008 when the primary dealers acted as a buffer in terms of interest rate movements. Since that time, we've had more and more funds and offshore investors supporting the market for treasury issuance, and they tend to take a view. So after we saw the Fed cut and some economic numbers came out, next thing you know, we have this huge short position building up in treasuries, and that took yields up. What are we going to do now? I think after the election, you'll have a bit of a relief rally. You'll probably see 10s come inside of 4% again. But I am not that sanguine about the long term because Treasury still has to go out and raise money. And again, we still don't have a clear direction. It's not like the chairman of the Fed can get up there and say, I'm worried about jobs. That's kind of where they were headed in September. But I don't think they have a clear path right now. If you're one of the larger players in treasuries today, it's a carry trade. It's a leverage trade. And it's well over $1 trillion now. We wrote about this the other day. So I think for the Secretary of the Treasury and the Fed and all the other players who are looking at those markets, the movements have to do more with the speculative positions that the players, the hedge funds and others are willing to put on than it is about fundamental economics. It's not like 20, 30 years ago when basically interest rates were the province of the Fed and investors. No, today you have people who are using leverage to bet on which way treasuries are going to move next, particularly the longer dated paper. So that's the one hand. And then on the other hand, you have the Fed taking a fairly passive role in the markets. They are running off their treasury securities. They're not running off their mortgage securities. And that has created some asymmetries in the market that I think Powell or his successor will have to deal with. I've suggested to people that if, we see any progress on the deficit coming out of this election, I think you'll see rates fall because there's so much liquidity out there. Americans always want to spend rather than raise taxes, especially if you have to get reelected. That's a common problem that's been with us for 200 years. But I really think that we're at the point where any politician or group of politicians in Washington that start focusing on fiscal issues are going to get traction. Nobody wants to see cuts. Nobody wants to see our standard of living reduced. But if you look around the world, there's not a single industrial country that is not feeling the bite of debt, that's not feeling the constraints of debt and inflation. And even Japan, they've actually gotten up off the floor. They just had a very surprising election there where the ruling party lost. It's going to become topical to talk about the deficit again. The Democrats obviously don't want to do that. But I do think the Republicans are going to have to make a stand because otherwise we have problems. When you have as many wars and military engagements as the United States has around the world, you're going to waste a lot of money. The nice thing about Elon Musk is he's a defense contractor. He understands. So I wouldn't mind turning him loose at the Department of Defense to see if we couldn't save 5 or 10% of total spending, because there's at least that much waste. The way the U.S. wins wars is by burying our adversaries in logistical capability. We oversupply everything. And, you hear lots of arguments today about whether or not we should have trade barriers and everything else so we can produce what we need at home. But the reality is Americans win wars because we're really good at logistics. So I think Musk actually might contribute something if he were to focus on that part of the budget and see if we can't save some money. Government spending in the U.S. is no more efficient than it is in communist China. Most of it is transfers from one party to another. The government doesn't really invest. When government gets involved in encouraging investment, for example, electric vehicles under Joe Biden, it becomes a disaster. The amount of money that's been lost on EVs by private sector firms, look at Ford Motor. Look at the money they flushed down the toilet with EVs and electric pickup trucks and everything else. There's no market for these vehicles yet. They're just not practical. But you can't tell that to the progressives because they said, oh, well, we have to do this. So it's unfortunate, but all politicians want to get involved. They want to put out press releases. If you look at what's going on in China today with the state and local governments, who are all busted, the central government in China has got to bail them all out. And we're talking hundreds of billions, trillions of dollars of expenditure for which there are no assets. There's nothing to restructure because the money's gone. And in the U.S., the same thing is the case. We transfer money from one to another. We have obviously military spending and that sort of thing. The defense sector is very much tied to the government, obviously. But I think that what you have to realize is that all governmental spending is essentially a transfer. There's very little residual assets left over as a result. And it's just the nature of the system. America's been that way since the Civil War. When Abraham Lincoln decided he could issue paper money to pay for the conflict, that was really opening the door for a lot of expenditure in the U.S. that we see today. So that number, a third, I think that's too low. It's probably closer to half. But it's only the private sector that creates jobs, that has real leverage in terms of being built on real assets. Government sector is just expenditure. That's all it is. Well, Bank of America has not been performing very well. We just rebalanced our bank index. We look at the top 100 or so institutions in the U.S. and Jamie's at the top, Wells Fargo's in the top quartile. Bank of America's kind of in the middle. They're still not performing that well financially. They have a huge following on Wall Street in terms of people that want to own the stock. But the reality is that Brian Moynihan's just not a very good manager. And so his financials have always been mediocre. And then we have Truist and Citi down in the bottom quartile. They have not been performing well at all. So, when you think about a Warren Buffett, he wants to put money to work in a large public company where he has liquidity. Jamie Dimon's probably too expensive for Warren. There's no real value there because he's already leading the pack. Warren wants to buy a company that's kind of cheap today, but it's going to do better. What do? You go out and buy Boeing. You go out and buy, any number of companies that, fell during the last couple of weeks during earnings, right? Look at the volatility we saw in some of these stocks. They had even the most modest disappointment. Someone like PayPal, that's a $100 billion market cap stock, right? Got crushed after they announced earnings. And there's all sorts of examples in pharma, in other areas. And the next thing you know, the stock's off 20, 30%. So what we're seeing is volatility in markets. And I think it's very difficult for investors to really discern value today. It's a question I get asked the most by some of my readers. People are so used to following the Fed, really going back the last 10 years. If you followed the FOMC minutes, you pretty much knew what was going to happen. You knew that rates were going to stay low and equities were going to melt up, right? That's not so clear now. So I think, to me, I want to be in the winners. I want to be in the best performing stocks in every sector I look at. So I'm not so keen on NVIDIA right now, just for my own portfolio, but I have been buying ARM. I love ARM. I've been following that company since it started. I've been in and out of the stock. I think their position in tech is going to be very interesting going forward. And it's because they ultimately control a lot of that small technology that goes in phones and everything else. If you look at our bank index, there's only 2 names that have been in the top 10 all year. JP Morgan was one, and East West Bancorp, great performer. These are consistent, stable companies that deliver earnings. Another one that's been in our top 10 group a lot was Ameriprise. It's kind of a little version of Charles Schwab. Again, knocking it out of the park, it's 8 times book value. It's not cheap. American Express is over 6 times book. So, you look at that and you say, God, it's a great company. I'd love to own it. Of all of them, Schwab is probably the cheapest right now. But these asset managers or asset gatherers, as I like to call them, perform very well and they don't have much credit risk. People have been shy about companies that have exposure to consumers because they're worried about a recession somewhere down the road. And you've seen this with banks. A lot of the consumer-facing banks still haven't recovered since second quarter of this year. And that, I think, reflects the fact that people are not sure what's going to happen with the economy. And so they tend to hide in some of the better performers. Now, does this help Warren Buffett? No, because none of these are big enough for him. Warren is kind of in the position like some of the hedge fund and private equity guys that you and I know, right? He should give the money back. But it's so interesting that all over the world, in credit, in tech, in financials, you see people who don't really know exactly what to do. You see a lot of creative destruction going on in certain sectors, or not creative, but really bad destruction, private equity, commercial real estate. Those are areas that people want to avoid right now. It's hard to make decisions about allocation. It's hard to make decisions about direction because we're all kind of up in the air. So used to following the guidance from the Fed, and they don't know which way they're going right now. There is no clear direction. There's nobody pounding the table saying, hey, you should go buy this. It's just not clear. I have about half of my personal nut in preferreds and debt and the other half in equity. And I think you want to be at least 50-50 because the equity is going to outperform the debt. Ultimately, governments that have lots of debt are going to force rates down and they're going to punish you if you stay in debt too long. So you got to be opportunistic when you're playing with bonds. That doesn't mean you can't make money. There's a lot of people out there betting on short-term movements in treasuries. I do financials. I follow some of the tech sector because I used to bank that sector. I used to bank semiconductor cap equipment. It was like a science project every day. Yeah. I'll never forget, I worked on one deal where these guys wanted to do chips with copper. And copper is the most difficult element in the world to work with because it oxidizes as soon as it touches atmosphere. But the reason copper was so attractive to some people in semiconductors is because the atom is very small. If you want to make silicon with tiny, tiny features, copper is kind of a cool atom to work with if you can figure out how to do it. Another area I follow is transportation. Obviously, I wrote that book, Ford Men, years ago. I own Toyota. Why? Hydrogen. I think Toyota may actually figure out a way to use hydrogen for transportation before the other manufacturers. If they do that, that's going to become a tech stock. Hydrogen is the most fascinating element, and it's also the most difficult because everything it touches, it corrodes. So to contain hydrogen in a vessel so you can actually do stuff with it, right? You remember the Hindenburg. But hydrogen is, again, one of the smallest atoms, and it is extremely available. We have tons of it. And if we could use it, solar, hydrogen, both of those would work. Much better than nuclear, too, by the way. I think the upside risk that most people don't recognize or don't want to recognize is that we could see much higher long-term interest rates. This would tip over some of the big banks. We were talking about Bank America. If we had a 10-year Treasury note at 5, Bank America would be in a lot of trouble because their securities yield down in the 2s. So they would be points underwater on funding. And I think that's the possibility that everybody assumes is not going to happen. They assume that the Fed can control this. I think they're wrong. I think Powell, FOMC, has taken far too long to recognize that they need to restructure their balance sheet. That said, why doesn't Jay Powell call Sandra Thompson, the regulator for Fannie Mae and Freddie Mac, and start selling some of those mortgage securities into CMOs? Put them away forever. We don't want to see them. The reason you do that is it gives the Fed the flexibility to buy treasuries if they have to. They may have to turn QE on again. And I think that's going to be a shock to the markets. Everybody assumes that the Fed can make it better and it's going to be okay, no problems, right? But what if the Fed loses control and we see long-term rates going higher? That, I think, would spook the market.